co-head of ESG and an equities analyst at Perennial, and I primarily work with Perennial Better Future, which is all about finding small to mid-cap ASX-listed companies helping to pursue a more sustainable future.
So, Emily, the ESG, I guess if you call it a sector or industry, is quite a massive thing. How can investors break it down into something like more manageable? Like, are there subset categories? How do you think about it?
Yeah, definitely. So the ESG universe is massive and it's growing, by day. I mean, just in global ESG funds, there's over 2,300 options, and that spans across, listed equities. We've got fixed income, debt, private equity, VC. So there's a whole bunch of options. Then investors also have a choice between passive or active ESG funds. So it is really broad. So I guess what investors should really be thinking about is, do they want to manage all of their holdings in a sustainable way, or is it more of a satellite approach? We do think that there is no performance trade-off when investing in a sustainable way, and so it does make sense to definitely have at least some allocation to sustainable investments to help capture those tailwinds. There's a number of ways that you can identify the best option for you, and there's a number of rating agencies out there that look at giving qualifications or accreditations to funds on ESG. So there's the Responsible Investment Association Australasia, also known as RIA. So RIA has responsible returns, which basically gives a certification that a certain product is sustainable. And that's a really great way you can filter by the type of exclusion that you may want to see, or the type of positive screen, and we'll jump into that in a little bit. RIA also publishes their responsible benchmark, and that identifies the key sustainable leaders in the industry across super funds and managed funds. So it's a great resource if you want to check that out. We also have the Ethical Advisors Co-op, which is a cooperative of financial advisors who have an ethical mindset, and they actually rate funds on a greenleaf and superannuation funds on a greenleaf rating scale. So that's another tool you can use to check out. But I guess the key things you want to consider when investing in a sustainable product is that, does it align with what you'd expect to see in an ESG fund? The best way to do that is to go in and look at their holdings. So we think best practice is to publish a full list of holdings in the fund and do all those companies in there identify with what you'd expect to see in a sustainable product. And that's really key as an investor. If you are keen to have an authentic ESG product, making sure it aligns with what you'd expect in that fund.
That's a fantastic overview of the ESG kind of sector or industry, depending how you want to frame it. What are some of the ways that people can use ESG investing? So what are common strategies that investors are using throughout Australia or even globally?
Yeah, great. So I guess we typically think about responsible investing on a scale. So anywhere from avoiding harm to generating positive impact. So it is scale. And it's important to note that funds don't necessarily fit neatly in a category. There can be elements across all different areas of sustainable investing in one fund. But I will just go across some of the key defined ways to think about sustainable investing.
Sure.
So the first one on the kind of avoiding harms sector of the scale is ESG integration. So that's all about traditional portfolio management, but you're actually using ESG as an additional factor into the risk and opportunity set. So you may look at all of the typical fundamental factors of an investment opportunity, but you'll also consider ESG. So whether that's ESG scores, or you might look at their disclosures or engage with companies. So that's kind of what we call ESG integration. And then we have negative screens or exclusions. So that's all about not investing in companies that have revenues from harmful activities. So whether that's fossil fuels or gambling or alcohol, this is really kind of the traditional form of ESG investing and goes all the way back to religious groups many decades ago. So the next one on the scale is what we call positive or best-in-class screening. So this may be seeking out certain sectors or industries that we believe are having a positive ESG impact. Or in the best-in-class approach, what you do is you take a sector and you invest in the best performing ESG companies within that sector. So, for example, if you're looking at consumer retail, you might identify the companies that are performing best on environment, social and governance in that sector, and that's your investment set. The next level across is what we call sustainable thematic. So that's about investing in sustainable themes. So that could be decarbonisation, or it could be a gender diversity lens, could be aligning with the United Nations Sustainable Development Goals. So it's all about targeting a key theme in sustainability and investing in companies that contribute to that theme. And then finally, we have impact investing. So this type of investing is all about identifying companies that have positive and measurable environmental or social impact. Typically, we see these types of funds in more of the private equity space, but we are seeing a few in listed equities as well. So they're really focusing on that outcome of environmental social benefit alongside financial returns. So as I mentioned, funds don't fit neatly within those categories, and they can be crossover. And there's also other, styles like engagement or corporate advocacy, proxy voting, and they can be across all of those different types of ESG investment styles.
So there's like a broad spectrum of responsible investing, ethical ESG investing. How do you think about the risk reward profiles of some of these strategies? Is it a common misconception you would say that it costs you returns to invest through an ESG lens? Any kind of context around the risk and return would be great.
Yeah, definitely. So I think it is a bit of a misconception that you can't have sustainable investing alongside financial returns. We believe that you can, and we can dive into that a little bit in more detail later. I guess with ESG integration, typically that's thinking about weighting sustainability into the investment process. You don't have to take much benchmarking risk, but you may reweight companies more or less depending on their ESG scores, for example, or your engagement outcomes. So that's probably a way to not take benchmarking risk when you're thinking about sustainability investing. Impact investing is a little bit more on the risky scale because you're only looking at companies with a positive environmental or social outcome. So these can be in areas like social housing or not-for-profits or microfinance, for example. So I guess negative screening is probably where we see what people refer to as benchmarking risk. So because you're actually excluding certain industries or sectors from the investable universe. So that means that you might be look quite different to what the benchmark is, like the ASX 200. So traditional equities typically fall into this space. And so, you without the negative screens, it could be a similar risk return profile, but because you are excluding those sectors, you do get a little bit more benchmarking risk there. Okay. What typically happens in ESG funds is that they could be underweight resources and mining and overweight IT and healthcare. That's a global, assumption about ESG funds. So that means that when those sectors are outperforming or underperforming, you can get some skews in the portfolio. And we have seen that a little bit recently with where resources kind of rallied, and typically ESG funds are more underweight those type of companies. So you do get some of that risk. In saying that, what we do think in looking at a company from an ESG perspective is just another lens into the investment process. So you're actually considering risk and opportunity on another level with a business. So in a way that actually minimizes your investment risk because you're more likely to avoid things like reputational risk, legal risk, policy change, fines, regulations. So it actually is a tool to help you reduce your risk profile. And typically ESG funds are less volatile than their mainstream peers. So it's actually quite an interesting tool to help your risk profile as well.
So it does, I guess the proof is in the pudding there, where you do have that sustainability lens, where we're presumably looking at more sustainable companies, therefore tends to have lower volatility in certain respects. How about, Emily, when you look across Australia or throughout the world, who would you say are some of the more successful investors in the ESG within the ESG landscape? Be they active investors or not, private investors. Who do you look to for information as a credible source?
Yeah, great. So again, this is not financial advice, and obviously do your own research and talk to a financial advisor. But there are groups that we think are doing a really good job on sustainability, and one of those I mentioned a little bit earlier, the Ethical Advisors Co-op. So they're a group of financial advisors who can help you understand the sustainable landscape. And I think that they do a really good job, and they actually rate both investment funds and superannuation products on sustainability. So a great tool to identify some of those funds or super funds that might be doing a good job. There's also some super funds that are really focused on sustainability. So we have Future Super, which is all about not investing in fossil fuels, and we have Verve Super, which is all about gender equality. So I guess some super funds that are targeting specific sustainability outcomes. But there's also some industry funds that are doing quite a good job as well. So Australian Super and Aware Super, they have large investment teams. They're doing a lot on sustainability and engagement and driving collaborative investor groups. So things like Climate Action 100 Plus, which is all about targeting the world's largest greenhouse gas emitters. So they're quite active in that group, and also Investors Against Slavery and Human Trafficking, IST APAC, is another collaborative engagement group led by these funds to help drive and identify modern slavery risks in Asia Pacific supply chains, which is really interesting.
Yeah, it's one of those areas where we're looking for leaders in this sector to kind of show us what is best in class and what is not. How do you go about thinking about your own ethical or sustainable screening process and building a portfolio of companies for Perennial?
Yeah. So I guess Perennial, we think, has a really unique way of doing it. But in general, there's no one size fits all. As I mentioned, there's a whole landscape of sustainable investment styles that you can choose, and it's best to understand those so you know what you're actually investing in. But I guess what we typically start with is a negative screen. So you're identifying the sectors and the revenue generation activities that you don't want to invest in. So you want to avoid exposure to those sectors because you believe that they're going to experience reputational risk, increasing regulation. They're going to be subject to that changing consumer shift as well. So we want to avoid those types of things. So that's our first step in the process. And then ESG investing, as I mentioned, is very similar to traditional investing. So we're also looking at those traditional investment frameworks. So focus on the fundamentals. We're looking at profit and loss statements, balance sheet, cash flow generation, management expertise, competitor landscape, the economy and where it fits in. So we're thinking about all of that kind of stuff, but we're also adding an additional lens on the sustainability. So what is the business purpose, and is it having a positive or negative impact on environment and society? And what is it doing from a corporate perspective? So we really want to understand, is the business and the management teams focused on sustainability across their organisation? So are they treating their staff well? Do they have a diverse employee and management base, whether that be gender diversity, background or culture? Are they governed in the appropriate way? Are they incentivized in a way to help maximize long-term shareholder returns? Are they being good corporate citizens? So these are all things that we think about in addition to the fundamentals. Some funds do use a scoring system on ESG, and that's the same as Perennial. So we have an internal scoring mechanism where we rate companies across environment, social governance, and what we call engagement. Right. So that's a little bit of a unique feature about Perennial, and that is about whether companies are addressing and improving on their ESG and sustainable risks and opportunities. So that's a really important factor for us. But a lot of other funds use external rating providers that might look across many dynamics and data on sustainability, and they do that. But for us, we do it in-house, particularly given our small cap focus. There's also a number of ESG data points that you can then look at. So whether it's in the sustainability report, the annual report, the company's presentations, a really great source of information is a company's website. And that's really easy to access for investors. They can just go on and see, what the company celebrates as their sustainable practices. And we also use data points. So we use a number of sources to help us identify, climate risk or their sustainable development goal contribution. I guess the focus for us, which is again a little bit different, is we're actually targeting companies that we think are going to benefit from sustainable tailwinds. So typically these are in sectors like healthcare, renewable energy, low carbon technology, water resource, efficiency management, improving social welfare, whether that's employee engagement or workplace safety. So they're kind of the target areas for us and the themes that we focus on, all about companies that are helping to shape a better environment and society. I think also ESG, what's a little bit different is ESG investing does take a really detailed view on proxy voting as well. So when a company has an annual general meeting, which happens once a year, annual, they have to put to market where shareholders can vote on certain business activities. And what we see from ESG funds and ESG investors is a more active role in that voting process. So they may make a protest vote where they're not happy with how some of the sustainability risks are being managed in the business. So, they may decide to vote against directors where the gender diversity on the board is not adequate. They may actually put advocacy proposals forward to the board as well on climate change, for example, or social risk. I mean, we saw it with Rio and the blasting of Juukan Gorge. So we do see that ESG funds tend to take a bit more of an active role in the proxy voting process. And, areas like modern slavery where there's risks and you can see some protest votes. Investors may vote against the remuneration report because they don't believe that the management team has adequately managed those ESG risks.
In your portfolios, what's a typical number of holdings?
Yeah, so for us, we hold between 40 and 60 stocks in the portfolio, and they're all across the small to mid-cap space, because that's where we believe the innovation for sustainability is a key there. But we have a really large investment team at Perennial, so that helps us go out and identify great opportunities. And it's also an area we think we can have the biggest impact from an engagement perspective. So these smaller companies don't have big sustainability teams, they don't have shiny ESG reports, and that allows us to go in and help them identify what's material to their business and help to drive ESG improvements. So that's the area that we focus on.
Fantastic. So you mentioned that ESG can take many forms and also can apply to many different asset classes. How do you think about the long-term historical performance of ESG funds?
Yeah, absolutely. So there's no financial trade-off to invest in a sustainable way, and the research definitely helps to confirm this view. And it kind of makes sense when you're thinking about when you're considering ESG for a business, you're helping to mitigate some of the risks associated with poor performing environmental and social performance. So I mentioned, you're less likely to get environmental fines, for instance. You're less likely to be subject to changing regulation. For example, we saw the Commonwealth Modern Slavery Act come in, where companies with over 100 mil of revenue had to report on modern slavery risks. And that really shone a light on companies that weren't managing their modern slavery risk well. That's an ESG risk. And so we want to be on the forefront of that and avoid companies that are not doing the right thing, because they're going to be subject to more risk going forward. So it does makes sense that ESG funds should at least perform in line with the traditional peers, and that is what we've seen. So if you look at the MSCI SRI indices across, all world, USA, Japan, Asia, they've all outperformed the traditional MSCI benchmark, and that relationship has particularly strengthened since 2019, when we had the COVID pandemic, and that focused on health and well-being. We had the Black Lives Matter movement as well, and obviously the big shift in focus on environmental decarbonisation and alignment with the Paris Agreement. So the relationship really strengthened there. And a report for Bank of America found that 66% of the ESG indices that they looked at outperformed their traditional indices. So there is a positive relationship there. Even if we look at the RIA benchmark report, which measures ESG performance versus traditional peers over the last 10 years, we found that across most asset classes and timeframes, ESG funds performed in line, if not better, than their mainstream peers. So we can definitely see the relationships there. That's not to say that there will be certain times where funds will underperform or outperform, but over the long term, it does seem that ESG is helping to support that returns framework. And, as I mentioned, what we also tend to see is high risk adjusted returns as well. So because you're mitigating some of that risk, and we have lower volatility in sustainable funds.
So where can people go to find out more about your investment process and your filtering techniques?
Yeah, great. So you can have a look on the Perennial website and go to the Perennial Better Future page. We also recently started a Perennial Better Future LinkedIn page where we post some key information there. So please check it out and reach out to the Perennial team if you would like to discuss ESG or sustainability or the fund in more detail. We love to talk about it. So please get in touch.
Fantastic. Emilie O'Neill, thanks for joining me.
Thanks.